Welcome everybody to Capital's first panel of 2021. I'm Blair Silverberg. I'm the founder and CEO of Capital, and I'm really excited to be able to introduce everybody to our panelists, much more esteemed than myself. We've got Howard Morgan, who's the co-founder and chairman of B Capital, Chris Gartner, who's a vice chairman of Rothschild's investment banking business, Ashley Johnson, who is the chief financial officer of Planet, and then Alistair Goldfisher is going to be our moderator. He is from Venture Capital Journal. And so I'll turn it over to him, but we're going to have a wonderful discussion about a bunch of issues facing CEOs and CFOs in 2021. And so I look forward to a fun discussion.
That's great. Well, hi, everyone, and thank you, Blair. As Blair said, my name is Alistair. I'm editor at Venture Capital Journal, and really excited to be here today and looking forward to hearing what everyone has to say. Just a bit of housekeeping here first for the audience, for everyone that's dialed in and enjoying the conversation. Please go ahead and ask questions at any time. I encourage the interactivity. Although we have a bunch of questions that I'll be asking for the panelists, we welcome Q&A at any time from the audience, and I'll pick up the questions and ask them. So great. Well, again, thank you, everyone. Let's start off by setting the stage. Let's talk about today's environment. It seems like there are a lot of issues facing executives today as they embark on their capital raising. Start us off by talking about today's environment. I'd like to start off with Howard, if I may. How would you characterize today's capital raising environment?
The word
Howard?
frothy comes to mind. There is a large amount of private capital available at all stages of the venture world, from seed stage all the way to very late stage. And the other thing that's happening, which I'm sure get to at some point, is the SPAC world has made a new source of capital available and a way to go public at the same time that we really didn't have in any scale until late last year and now this year. So I would say that there's a lot of money available right now, a lot of funds, because of the low interest rate environment we're in, the zero interest rate environment effectively that we're in, have been able to raise much more money than they originally expected to. Investors looking for any kind of yield that'll beat zero and are willing to take a fair amount of risk for that. So that there is it's a great environment to be raising capital in. I'm not sure it's as great to be deploying it in, but it's certainly a great environment to be raising it in.
Chris, would you agree?
Absolutely. I think the only thing I would add is that we are seeing a bit of bifurcation in terms of where that capital is flowing. The investors, while there is obviously a lot of money flowing around, investors really want to back the winners. And I know that sounds like an obvious statement, but typically in environments, everybody sort of feels like, okay, if I'm the third, fourth, fifth player, I'm still going to have access to that same capital. And that just is not what we're seeing. We're really seeing it flow towards the number one, number two player. And people are actually willing to pay much higher multiples to get access to those winners. And the belief is, look, if the winners take all and they're able to grow, even if I'm paying a high multiple and there's multiple compression in the future, I'm still going to get a decent return. And they feel that's much less risky than taking a bet on somebody who's much further in terms of their market share and hoping they can somehow change that dynamic.
Everyone wants to fund the winners. You're right. Do you feel that way, Ashley? That unless you're, top in your sector, it's hard for anyone to raise money. Do you have any thoughts, Ashley?
Yeah, I think what you're seeing from investors is a desire to fund, the companies that are going to be the dominant leader or the disruptor, right? The primary disruptor of a market. They want the TAM to be big, and they want to see it reflected in both some combination of growth and a long-term capital efficient business model. So if you fall into that set of companies, I think you are definitely commanding a premium in this market. And you're seeing that both the private markets and the public markets. If you're not in that category, I think, the traditional rules apply of you gotta make a pretty strong case for why they should back your company.
None of you referenced the pandemic, and I know we all have pandemic fatigue, and we probably want to move on from it. But and a question for anyone: how has the last year impacted capital raising?
We have seen maybe there was a little.
Go ahead, Howard.
Maybe there was a little dip right at the beginning of the pandemic, but since kind of April or May, when people realized this was going to go on for a while, it's taken off, and both in fundraising funds for the venture industry. First, B Capital has raised some new funds in that period, and it's been quite easy. Even with LPs that we had never met in person, we had one LP who said they couldn't close because they hadn't had one of their checklist items was to have dinner with one of the partners, and kind of a week before the final close, they called back and said, okay, we decided we have to relax that rule in this case. So people started to really adapt, and that allowed us to raise. We've now done a number of investments in companies where we have never physically met the founders, even though that was also a rule. I'd like to have a meal with the founder. I'd like to spend extended time with them. Zoom meetings or whatever your favorite video conferencing technique is tend to work best at sort of a half an hour to an hour. When you get to 4 hours or 5 hours, people get real fatigue, and you get tired of seeing who else is living in their house and who's been popping in, and who needs them on and off. So we found ways to be efficient about getting the information we want and having multiple meetings over a period of 1 or 2 weeks to be able to get what we want. But I would have to say that in March, I was afraid it was going to be a really serious blow to the fundraising side of our business, as well as to the investment side. We've gotten past it all.
I'll second that and say that we work with companies that do anywhere between $5 and $150 million of recurring revenue, and for these businesses in particular, if they have a tech angle to their business strategy, either some real technology or an e-commerce company or so on and so forth, it's like the pandemic just never happened from a capital access standpoint. The one thing that is incredibly acute, I have a sneaking suspicion that Chris would agree with this as well, is cohort analysis. So is the change to your business model a temporary thing that occurred in April due to the pandemic? So like the food delivery space is one space that comes to mind where, there's just a fundamental shift to consumer behavior. And is that going to reset? And so that's a question that we're seeing a lot of investors ask. And the solution to that question is cohort analysis. So if you're able to say, yeah, here's a group of customers that I acquired, and here's what happened to them during the pandemic, and here's what happened when things started to reset, and here's what it looked like when there were stay-at-home orders, and then those were lifted, and then those were put back in place. The more granular you can understand and explain your business and articulate that there wasn't a one-off blip, either positive or negative, but there's some kind of sustainable underlying trend of the business that's still strong, the easier it is to respond to that question. But in terms of capital access, there's a lot of capital out there.
If I could just add one thing, because I think it's a lot of businesses, there is a COVID asterisk, and I think businesses have to be careful because some people benefited from the acceleration that took place as a result of the pandemic. And other people, we've actually seen a number of founders who said, look, I don't know how long this is going to last. They were providing the capital themselves, and they actually became somewhat conservative. So while their businesses did fine, they gave up on a lot of growth because they didn't want to lose money in an environment where they just weren't certain what was going to happen. And I find that's almost as though if the money was coming out of their pocket, they were much more conservative. If it was investors' money, investors generally said, no, continue to invest and build share. So that COVID asterisk in the financials, I think, is going to cause a lot of people to spend time talking about dynamics that may not really be relevant going forward. And it's unfortunate, but I think that a lot of companies are going to have to at least get through explaining what happened during the pandemic and how it's going to impact them going forward before they can really talk about their business on a forecast basis.
We did spend part of March talking to every one of our portfolio companies and sort of triaging them into ones that would be helped by COVID, hurt by COVID, sort of, or neutral, and giving them advice in terms of so in March, April, we saw probably a quarter of our companies take on additional capital at last round prices to get through this whole thing. And once that happened and they got through April, all of a sudden prices started to rise and it was no longer last round prices. It's now, as you pointed out earlier, Chris, in the bifurcation, if they're one of the leaders in their field, the prices started to skyrocket.
I was actually curious if it's okay, Alistair, if I just ask a quick question for really for anybody, but certainly for Chris and Howard. So what do you do if you are not currently clearly one of the leaders? You might have a great business model. It's efficient. You can invest, you can grow more. Maybe you can invest enough to become one of the leaders. But what advice do you have if you're running a great business? It could be like a $50 or $100 million business, but in your space, you're not yet one of the two leaders.
Well, first of all, you try to show your potential investors how you become one, which is to say that your growth is faster than the leaders. So as long as you can outgrow the leaders, if the leaders are growing at 5% and you're growing at 50, you can say, and so we're on target to pass the leaders in X quarters. So that's a big step forward. The second is to say we're taking business away from them. Here's a leader, and yet we've had people cancel their subscriptions with them and sign on with us.
I would just add that I think companies need to be self-aware, and you have to understand if you really do have a shot at taking one of those leadership positions and you have a solid plan, as Howard was saying, being able to communicate that I think is important. If you really can't, it doesn't mean that you don't have a bad business. It just means that you have to be realistic with regards to value if you want to go and seek outside capital, or if you want to run it as a lifestyle business. I think it's not a question of the business going away. It's just a question of making sure that you don't spend your time trying to raise capital in an environment that's just not going to support you. Everybody's time is incredibly important, and you want to spend that time as efficiently as possible. So that self-awareness, I think, will help people in terms of guiding where they try to find their pockets of capital, or whether or not they can hit the home run.
Any thoughts, Ashley, before we move on demonstrating that you're a leader in your category?
Yeah, I think they've hit on some of the key things, which are around, the ability to demonstrate the underlying metrics of your business that show the strength and really point to the long-term story that you're telling. I think anytime you're going out to fundraise, you're not really talking about what happened last year or even this year. You're talking about what's going to happen in 3 to 5 years. And you got to be able to point to the underlying metrics that support your story. So.
And are you tired of talking about the pandemic too, Ashley? Does that come up often with investors? How you survived it, your next stage? Yeah, go ahead.
Yeah, it doesn't come up nearly as often as it used to. I often share the story of one of our investors asking us in the April timeframe, well, what happens if nobody, your sales team's still not able to get on planes in the fall? And I had just joined the company as CFO, and so I kind of tongue in cheek said, well, I hadn't run the zombie apocalypse scenario, but I suppose I could do that. And so I've had to eat my words just a little bit, but I think the thing that we've come to realize is that everybody is in this. This isn't a sector-specific situation. This isn't a country-specific situation. Around the world, every customer, big governments all the way down to small enterprises, are figuring out how to do business fundamentally differently because we have to. And so as a result, once you've adapted to, okay, my go-to-market motion is now going to look this way. And, our sales leader, how is he going to enforce the MEDDIC processes that he's put in place in this new environment? How is he going to do rep assessment and deal assessment and really understand the commit forecast and, do all of that in a very different way than, getting on an airplane and attending a customer visit with the sales rep. I think all of that's been worked out in the last 9 months. And so now it's, I don't think it is the zombie apocalypse that if you asked the question back in March of last year and said that this pandemic would still be going on in January 2021, everyone assumed, the worst case scenario.
Yeah.
Well, great. Moving on, again, thank you for the folks in the audience who are submitting questions. I see some coming in. One of which is regarding the SPAC question. So maybe we can jump over to a discussion on SPACs, a popular topic. I mean, they didn't come out of nowhere, but they certainly dominated last year. A question to anyone in the panel: why did you see that they were so popular last year? What gave rise to them?
Chris, why don't you start?
Sure. So, look, I've been the banker for just about 30 years, been involved in a lot of IPOs, taken a lot of leading tech companies public over the years, and I sit on the board of 2 SPACs. And I think what's happened is SPACs have been around for a long time. I think it's a little bit different now because of the people involved, the capital behind it. And we always knew, even when I was first doing my IPOs, we sort of knew the IPO process was a little bit broken and there had to be a more efficient way. And in Google IPO, when we were doing that, we tried an auction, and that was a little bit more difficult to do and didn't really solve the problem. And I don't know if SPACs are the answer to solving the mispricing. I don't necessarily think it's going to answer all the questions, but it certainly allows for a little bit more direct conversation with the buy side, and it allows you through the merger proxy to tell the story directly and the forecast as opposed to going through an analyst. So I think there's some definite benefits that the SPAC brings: confidentiality, speed, all those things. And I think that people have finally said, look, the IPO process is fine for some companies. The SPAC process is fine for some companies. Direct listings are going to be fine for some companies. I think what's perhaps a little bit different now is that it's just part of the discussion. Every board, every management team now wants to discuss it as one of their alternatives. And because of the success of some of the companies that have gone, which I think is, by the way, the value of the promote is obviously going to come down as that becomes more competitive. So I think some of the incentives won't be there for the SPAC providers themselves. But with that said, I think SPACs are going to be part of the discussion and part of our go forward capital access options for the foreseeable future. I don't think we'll go through quite the same cycles it's gone through in the past.
What drives them, out of curiosity? Because I've noticed that the compensation for the SPAC manager can be far superior than similarly kind of running a fund. And so I'm curious how that part of the market evolves, because that'll drive a lot of the availability of SPAC vehicles.
Yeah, so I think in terms of the promote, the sponsor, and it all depends on which sponsor it is, but the sponsor promote is 20% of the capital they raise. And then you typically raise about an amount equal to around 1/5 of the target that the enterprise value of the target that you're going to merge with. So there is dilution there. If you run the numbers, the dilution is not too far off what it is from a typical IPO, depending. But the other piece is that promote is typically part of a negotiation. So you have the warrants and you have the underlying shares. And as depending on the SPAC, what they bring to the table and the attractiveness of that particular partner, sometimes they give up warrants, sometimes they give up promote shares. So that dilution, as I said, particularly as the SPACs become more competitive in a SPAC auction for a particular asset, is becoming, there's less and less promote to actually go around. And I think that's.
I agree with you, Chris. I've seen recent reports that the promote's sort of gone down by 6 or 7% already through those negotiations. But in fact, the SPAC really does offer some advantages in that, companies who see their stock double on the first day of trading get very frustrated, and particularly when their employees have sold at the IPO price and then they see at the end of the day they gave up half for the gain. Now, usually that's because there's no supply of stock. So one of the interesting things about SPACs is there's a lot of negotiation around lockup, and with some SPACs, there's much looser lockup restrictions than there are on the typical banker IPO. Typical banker IPO, the rule of thumb was sort of 6-month lockup. You look at the SPACs, and they're much more complex. First round, which I used to head with Josh Koppelman, had Clover Health was one of our companies that got de-SPACed and listed recently. And the lockup is until the first earnings release, except that if the stock trades above a certain price for 10 consecutive trading days, then some of the lockup is released. And if it trades above a higher price, then more of the lock. So it gives a lot more room for negotiating how much liquidity to put into the market, which is better for price discovery, really. So you don't get this, gigantic pop, and then 3 days before the lockup release, you get this gigantic drop as people anticipated. And so I do think, as Chris said, it's another alternative, and it's a little smoother in many ways than some of the traditional IPOs have been, which will force them to renegotiate the lockup release provisions to be more in line. So I think we're seeing that. The other thing is that the way a SPAC works is you raise the money in the SPAC, and you have to put it in treasury bills and when you decide on the merger target, the investors have the ability to just take their money back, but they still get the warrants they got when they went into the SPAC. So some people are using this as a device to basically say, well, I'm going to get T-bill interest rate through the SPAC, and then I have the warrants, and so I'm not going to invest in those companies. I don't know what they're doing, but I have a stack of warrants here that might be worth a lot of money or might be worth nothing, but at least I got my treasury bill rate. So it offers some more goodies for to pull the investors in various layers into the SPAC.
That's a little bit of my question, if I can interject, is, at some level it feels like win-win-win, right? So the promoters, and especially when you see some of the returns that the promoters are making off of the risk that they're taking, and they are taking some risk.
Yeah,
that looks very attractive. The investors kind of get a free look, right? They, as you said, they put their money in T-bills. They can hold on to the warrants and take back their capital if they so desire. And then the companies, get a different path to market. They can tell the story in a different way. And they frankly get access to a slug of capital that's a bit more flexible, right? You can use it for secondary. It's in that sense. So, with that, I can't help but think, well, what's the catch? When does this all unravel? Because it feels like there's a lot, right? All of a sudden we went from 10 years ago, there were a couple of SPACs, you heard about them, maybe not the best companies. And now you've just got this flood. And I probably get 1 to 2 new phone calls a week from SPACs I hadn't heard of, and people who I haven't been in touch with for 15 years. So I'm just trying to figure out what's the asterisk, what's the catch, what makes this all unravel?
Well, one thing is CNBC today, I was listening earlier, said that there are 3 space SPACs filed today, just for this, with space as the focus.
Yeah,
what makes
it
unravel?
Space ETF.
Yeah, what makes it unravel, obviously, is the overpricing of the companies that they put in the SPAC, so that the performance post the de-SPACing, post the merger, isn't good. Right now, people are trying to be very selective and careful and picking good companies that they know or believe will perform well over the first year to 2. But when they start moving further down the stack of companies and things start to not perform well, that's when the investor will get hurt.
There's a fundamentally different incentive, though, for the investor that you were describing. So, if I have the ability to put up $1 in a T-bill and get some free warrants and take my $1 back, that's totally unlike investing in a venture fund where my $1 is in there for 10 years, nothing I can do about it. I hope it works out. That's a totally different incentive. So does it drive flightier, less committed capital to come into businesses that are fundamentally still, because they're nascent, long bets on kind of consistent performance with a long-term time horizon? Is that mismatch something that is concerning?
Well, I think I would say there's certainly a number of companies who are trying to de-SPAC, who were basically a business plan. And everything is on the come, and nobody really knows what this is going to look like, other than the fact that you're looking at some financial projections. And to Howard's point, those are the businesses that could ultimately crash the SPAC market. If the too many of them get out, then, and by the way, I don't think they'll just crash the SPAC market. Those are the ones that people will just say they'll be much more careful about investing in equities overall. We're in a bit of a unique time, as was covered earlier, where you can't get yield anywhere else, and in an environment where there's no other options. And by the way, GDP doesn't need to grow. Things just don't need to happen, and people will flow into equities. And on top of that, we're seeing a lot of new players, as we've discussed, who are just cannibalizing traditional businesses and legacy businesses. So there's a reason why capital is flowing from one place to another in an environment where you're not seeing a lot of GDP growth. So when that happens, they need capital, and SPACs are a new vehicle. And I think as long as we have companies performing, then things will be fine and the window will be fine. But as I said, I think it's SPACs will be viewed as part of the equity markets overall, because if they crash, then I think we'll start seeing IPOs become more difficult to get done, and direct listings as well.
I'm glad we're talking so much about the SPAC question. Be careful what you wish for, because a lot of questions are coming in from the audience regarding SPACs, how they function, what do they mean for existing equity holders. One question came in about, if I'm reading this correctly, in regards to SPACs, how does, this is actually more than just SPACs, but how does access to credit versus just equity alone, how is that impacting venture-backed companies in the public and private markets? I mean, it's kind of right, a rising tide lifts all boats. Is that kind of what we're seeing, that all this activity, is it benefiting venture-backed companies? Any quick thoughts here?
I think there's a few pieces to that question. So I'm just happy to kind of offer the credit angle, since I'm having those conversations every day with private companies. But I think that one thing that is really interesting about the time we're in is technology companies are the companies of the future. I mean, there's a lot of parallels, whether it's companies like Thrasio that are acquiring e-commerce businesses and rolling up basically a sector that was very fragmented before. That looks a lot like roll-ups of convenience stores or smaller local retailers. There's a lot of strategies that sort of existed offline that have now come online. And so a lot of the technology sector, it's defined broadly. It's like modern businesses. It used to be like chips and fiber optic cables. And now the technology sector is most businesses. A lot of people, Andreessen Horowitz does a great job writing about software is eating the world. So you have that kind of trend happening. Most businesses consume credit in some format. S&P-backed companies, a third of their capital structure comes from credit. Consumers who own cars or property have mortgages or auto loans. Credit is very common. A lot of people have credit cards. It's very unusual for there to be a sector, a large multi-trillion-dollar sector, like, for example, the Bessemer $2 trillion cloud index, where only 2% of the capital structure comes from credit. And we've seen this movie before. So in the 1980s, when Drexel Burnham and Michael Milken built the high yield bond market, that gave rise to new kind of financing that made it possible for businesses that were previously funded only with equity to get financed in alternative ways. And when those ways are less dilutive, that drives different types of business models being possible. So that led to the leveraged buyout boom, gave people like Carl Icahn and T. Boone Pickens their start. Famous kind of household names of financiers really built on the back of a new type of funding. So I think there's a little bit of that thread going on. So like insurance companies and some of the investors we work with will extend 2 to 3 times recurring revenue in credit capital to businesses, to really high quality, ARR businesses. And that's a new thing. and it's not that this is for everybody, and there's the pros and cons to different types of capital structures, but I think that's kind of the dead angle. But there were a couple pieces to that question.
Yeah, there were, and we could probably spend another half hour or so on SPACs. The title of the panel is Unlocking the Capital Markets, and I'd love us to kind of shift focus. It's sort of speculated, but not really. It's shift focus to talk about types of capital, types of money that's available out there. One question that came in, it was in regards to non-equity funding in the capital market right now, such as revenue sharing. Thoughts on this? I feel like maybe starting off with you, Chris, about what's, although this is a question for anybody, what's available out there? What should companies be looking at right now? Debt, for instance. Any thoughts?
Well, I think it's really a matter of, and I just want to make one comment about SPACs before we.
Yeah. Let's finish it off.
Because
absolutely, tie a bow on it. Go ahead.
People have to understand that with regards to SPACs, a SPAC will come and tell you, we love you, we love you, we love you, we want to do a deal. You'll have 5 SPACs knocking on your door saying, we're going to take you public, everything's going to be great, we're all going to get rich. The issue is that the SPAC doesn't price the deal, and they don't say how much capital is available. That happens when you do the PIPE. Now, the good, all of this is confidential. So I just want to make sure that people understand that yes, SPACs are a vehicle, but SPACs in and of themselves will not solve your capital problem. You still have to sell your equity to those PIPE investors so that they'll be the ones that determine all the things. If the SPAC is spot on with regards to their understanding of what's going on in the capital markets, great. But I can tell you there's an awful lot of SPACs that are out there making promises that the public markets are not really, the PIPE investors are not really there to support them. So I just
Who are the PIPE investors typically? Are they a fundamentally different group in most cases than the SPACs?
Well, you will get some SPAC investors who also want to participate in the SPAC IPO investors who also want to participate in the PIPE. And then there's just the traditional IPO investors, fund managers who are looking to do PIPEs and invest in companies. So it's a fairly broad universe, not too different than what you have in an IPO, though the size is typically larger. Mm-hmm. But in the prior to actually disclosing it, when you're going through that discovery process and that wall crossing process, you're going to have discussions with PIPE investors, and you're going to find out, well, okay, where is this thing really going to be valued? And that's one of the benefits, but it's also where the rubber meets the road with regards to, hey, look, can you actually do a SPAC? Don't pay attention to what the SPAC investors tell you. They'll give you some guidance, but the reality is that insight and that discovery with the PIPE investors themselves is what's really going to tell you what's going on. I'm sorry, I just wanted to make that point.
No, I think maybe we should be a little clearer for people who haven't done SPACs before. So what happens is you get a founding group, that they're the promoters. They put up all the cash to do the legal work to get something filed, etc. For that, they typically get 20%. That's of the stock. The next stage, and then is to go public and raise some amount of money, 1/5, as Chris said, of the capital you think you're going to need. And then you get this thing called private investment in public equity, or PIPE, which are the people who are going to put in the rest of the money that's needed to get that SPAC up to so it's a $200 million SPAC. They're going to do $1 billion acquisition. You need to find that other 800 million, and you need to find investors who will do some of that because the public is only giving you a portion of that, and they'll put that money in sometimes at a discount to the trading price. And so they are, as Chris said, the people who are sort of determining how much the target company is really worth and how much they're willing to pay for that target company. And so there are a lot of layers to the SPAC investors. There's the promoters, there's the PIPE investors, there's the public investors, and then there's the trading post the merger, or the de-SPACing, as it's called. So you've got sort of four layers of investors that are playing in the SPAC world today, each with somewhat different incentives. The PIPE investors want to get a good price and really, and they're again, because there's this tremendous scramble for any kind of yield, there are lots of money available at each of these stages.
Jumping over to Ashley, I almost want to ask you, if you're considering a SPAC, but maybe that's too personal. But as long as we're on this topic and we're talking about forms of equity that you should be going after, I mean, is SPAC kind of, does that impact your fundraising?
I think the
kind of
thing
the whole
that
SPAC model.
everyone has to remember is that when you SPAC, you're going public, right? And so your readiness to be a public company is a significant factor in the decisioning. It can be very tempting. And as Chris said, the promoters have a very compelling pitch when they come along about how easy it's going to be, how much faster it's going to be, how much more efficient it's going to be than the traditional IPO process, how they've got the best investors under their wing that they're bringing to the table, guaranteed the pipe's going to come in. I mean, it is quite it's quite a market right now. I've never seen anything like it. And I was on both the buy side and the sell side in 2000. So I feel like I've seen a lot, but this is really a unique time. But for us, the decisioning comes down to when are we ready to go public? And so, coming back to, do we have the right back office in place? Is that ready? Right? Do we have the right front office? Can we reasonably predict our financials so that we can give guidance and we can beat raise to drive successful stock price performance? Because as far as I can tell, that's still a key factor in the performance of the stock post-market. I know that with Robinhood and retail investors, there's a lot of other factors that come into stock price performance too. But my primary job is to understand what things I have control over. And so I'm going to look at all of those factors in weighing SPAC versus IPO versus DPO. At the end of the day, it is a mechanism to take the company public. And so if I'm not ready to go public, then I need to focus my attention on raising capital in the private markets, whether that's debt financing or equity financing. A key objective in my role is making sure that I'm using our balance sheet as a strategic weapon of the business and making sure that we're taking advantage of the financing options available so that we can lean into growth. So I'm understanding SPACs, I'm spending time with them, but until I'm ready to take the company public, that's not something I'm going to spend a lot of my team's time on.
If I can just say, I think
Blair,
go ahead. I think Ashley is in the catbird seat with regards to how to manage the current environment, because she can use SPACs as leverage in terms of discussions for any capital raise, because we know the SPACs are there and those. But that's just the reality. Anybody who's doing a C-series round, any of these larger rounds, it's available capital and it needs to be part of the discussion. So you can run these processes in parallel and you can just create competitive tension that is very helpful to the issuer.
It's also true that some of the SPACs, some of the big players have both in their arsenal. So we're seeing SoftBank starting a SPAC. They're a major player. Tiger 21 with a SPAC. Obviously, Social Capital has gone out and done a whole bunch of SPACs that are successful and is now sort of shifting to that focus, but still has a lot of capital available. So some of the big players like Tiger Global will come in and they'll say, okay, we'll do $100 or $300 million investment, or if you want a SPAC, we're going to have a SPAC next week, and we can talk about doing it through the SPAC if you want to be public sooner, or if you want to be public later, we'll fund you for the next year or 2 years or whatever. So it's not that there are SPAC players and there are venture capital players and there's the traditional public. They're all the same players are doing all of them.
I was curious.
Jumping off of something, yeah, Blair. I was going to ask you a question, but go ahead.
I'll hijack my question and ask Ashley a question. I just wanted to understand. Ashley, can you explain to the audience a little bit about what Planet does? I mean, I'm sure a lot of people in the audience know what Planet does already, but it's a really interesting case study of a business that has a very solid kind of, by the numbers, quantifiable kind of software business, basically. Mm-hmm. But it also has this amazing world-changing kind of story. And so I'm curious for the entrepreneurs, the CEOs and CFOs in our audience, who have those two pieces of their business. You've got like the sizzle and the steak, how you think about balancing those two when you're out fundraising. And obviously you've got companies like Tesla with both and an insane amount of sizzle. So everyone's sort of familiar with that extreme. On the other end of the spectrum, you've got, your very boring enterprise software company that is just all EBITDA and EBITDA multiple. And sometimes it's, somewhere in between that makes for a successful fundraising process that fits you and the business. So how do you think about that, given that you have both tools at your disposal?
Yeah, it's a good question. And sometimes I wonder if having a real business, sometimes is a disadvantage. Right? If we can just talk about the space side of our business and not have to talk about EBITDA. So just for those who aren't familiar with Planet, we're a data business, but our data is proprietary. We generate it by having the largest fleet of satellites, Earth observation satellites, orbiting the Earth every day. So we have over 150 satellites in space that are scanning the Earth and taking images of the entire landmass of the Earth every single day at the highest resolution available at that quantity. We also have high resolution satellites that can then zoom in on change that our software then detects from the images that we're gathering. So, and we sell subscriptions to the data. We also have tools on top of that data to do the analytics, whether that's for an agriculture company that's trying to understand the potential crop yields and the factors that might impact crop yields, either investments in technology or climate. And we're doing a lot of work around sustainability. So really trying to make the change visible that's going on the planet to drive real change in policy and corporate behaviors. So trends around the digitization of economies is really a big driver for our business. So the more data that's underpinning corporate decisions, the bigger a player we are. And also the trend towards sustainability globally. And yesterday was a very exciting day, rejoining the Paris Accord and everything else that yesterday signified. There is a lot of change, and the Green New Deal over in Europe, I think is really the direction that hopefully we're going to see a lot of economies going. And so, yes, we have a story to tell around big global shifts that are driving our business. And then we have, I guess I can say, a little bit of sexy with our space technology. Our company was founded by NASA engineers and astrophysicists. And so they can geek out with anybody who gets excited about space tech. But fundamentally, we also have a real business that looks like the capital efficient businesses in the SaaS space, because it is a data as a service business. So I think a successful story is able to talk about all of those elements. But as I said in the beginning, the story's fundamentals transcend any industry. You need to be able to talk to your TAM and the fact that you've got a lot of runway in front of you, and that runway is growing even faster potentially than you are. That you're the leader, so that you are the best position to capture that TAM, either disrupting an existing market or carving out new markets, or both. And that you're capital efficient, because if you look at the companies that are getting the biggest multiples in the public markets today, the reason they're getting those multiples is because they are capital efficient businesses. And so showing that through CAC ratios and gross margins and some of those fundamental metrics are kind of the bread and butter of telling a stock story today. So I hope that answered your question.
It did. Thank you.
Very much. Thank you. I wanted to get back to financing options. I wanted to ask a question about this, and I see an audience member asked it as well. Is as a company, how do you know if you should be raising debt financing versus equity financing? When is the right time? Is it just a matter of how much revenue you have? Is it looking at your competition? What are the factors in determining what type of financing you should go after, even if it is a SPAC, but specifically debt versus equity? Any thoughts there from anyone, Blair or Howard?
Yeah, sure. I mean, as a venture capitalist, we mostly deal in equity, but in fact, if you are confident that your business will continue generating returns, you'll get less dilution if you use debt. And particularly in today's world where debt rates are relatively low. Blair mentioned Thracio, which I was fortunate to be an investor in. Thracio was basically providing debt to a lot of Amazon suppliers, and taking the float away from how long it took Amazon to pay them. We're seeing a lot of other people being debt providers to businesses, particularly SaaS businesses, that need to spend on marketing, but once they lock a customer in, if their churn is low, if they can show an average 2-3 year life for a customer, they can borrow against that 3 years of revenue at relatively low rates to grow, as opposed to what they did 5 years ago, which was to take more and more venture capital and dilute the company more and more. So, but only take that if you're pretty sure that you're going to be able to pay it back out of continuing earnings, because the worst thing that happens is, for some reason, your business falters, and it could be COVID, depending on what business you were in, it could be something else. And all of a sudden you got this crushing amount of debt repayment due, and you don't have the money coming in to do it. And all of a sudden that small dilution may become a bankruptcy, or may become a much bigger dilution in a negotiation with your lenders, who say, well, sure, we'll take equity, but we're going to take equity at what might have been a rapacious price if you actually had taken it as an equity raise a year earlier or 2 years earlier. But we are seeing, particularly in the SaaS area, a lot more people using debt.
Yeah,
And you can
Go ahead, Blair.
Oh no, Chris, go for it. You go first.
Sorry, I was just going to say that if assuming you have the option of doing one or the other, in other words, both options are in front of you, then obviously looking at the cost of capital and making the decision that way, it makes a lot of sense. I would say the one thing that I think is lost in a little bit of this is that the counterparty, the person you're dealing with, matters, particularly companies that are growing, want to get access to capital in the future, in both debt and equity. Is the person sitting on the other side of the table? Are they sitting on the other side of the table, or are they sitting on the same side of the table? And typically, some firms, in terms of the debt deals, are incredibly impersonal, and it's really if there's any issues going forward, you hear from their attorneys, as opposed to situations where if there's any issues or if things go well and you need more capital, you have somebody saying, yep, we're there to support you. So I think that's one thing, that all dollars are not equal. And while they seem to be fungible in financial statements, the reality is that the people behind those dollars, I find, particularly companies that are growing quickly, dynamic environments, shifting sands, it does matter. So I hate to say that, look, it's not just an academic exercise in terms of what's cheaper, although that's a big part of it. You do have to figure out who's sitting on the other side or on your side of the table.
Yeah, and I'll just add to that you're really making a bet when you choose how to capitalize your business. And so if you're taking on debt, just like if you take out a mortgage to buy a house, there's a scenario where you can lose your business, and you need to know what that scenario is. And if that scenario is 2008 happens, and a pandemic happens at the same time, and my corporate office gets hit by an asteroid falling out of the sky, you could be 10 times wealthier when you exit your business because you've taken on debt. And so it's probably safe to take on debt if your downside scenario is very protected. But, just like a house, I mean, you really have to understand the scenarios and the math. And then once you understand the scenarios and the math, which is just table stakes, you have to know the answers to those questions. Then exactly what Chris is describing, not all lenders are created equal. And the trick is, when you raise equity in general, and obviously the quality of your legal counsel matters, but in general, think about that investor being on the same side as you and roughly having the same incentives. And so, it's much easier to think about a relationship when people are thinking about the world the exact same way that you are, or very close. A lender can have all sorts of covenants and complexities to the documentation and different scenarios and incentives that trigger in different situations. And so unless you can track that and understand it, which is very doable, but unless you do that, it's just a more complex instrument. So you've just got to make sure that you answer all the questions and really know the other side of the transaction as well as your side.
Winding down here, less than 10 minutes to go. What's one thing each of you would like to impart onto the audience? The CEO or the CFO in the audience who is getting ready or in the midst of fundraising this quarter or next. What's one thing that they should put in place? What's one thing that they should do?
Having lived through 1999, 2000, and several other crises, now's the time to raise. I mean, there's so much money available, and there's bound to be a shakeout. And the companies that raised in 99 and had enough money to get through 2001, 2 survived, and the companies that didn't, it was a huge drought, and they weren't able to survive. So if you're doing okay and you have a good story, now is the time to raise. Not necessarily with a SPAC or anything, but whether it's venture or SPAC or whatever, this is the time to do it.
Ashley.
Yeah, I would certainly echo those comments and make sure that you're funded, as far out as you can be. Don't raise it and spend it. I'd say also, don't underestimate the importance of getting systems in early. Because I think, again, a lot of these companies that you see are doing really, really well. They've got their metrics down, and they can tell a really good story about the fundamentals of their business. And so making those investments in your systems infrastructure early, and being able to really point to the fundamentals that drive your business will separate you from the pack when you're out raising capital, or when you go to take the company public.
That was a question I was going to ask you. How important is it to have a good story to tell investors?
I mean, I think that's everything.
It's everything. Yeah, right. It's the end all be all. Yeah.
Yeah, and I forget which person made the point, but fundamentally, you're bringing people into your business, whether they're debt providers or equity providers, whether they're taking a board seat or not. These are the people that you're going to be taking their phone calls when they call, that ideally you're going to be reaching out to for advice. And so, you want to have the best story possible so that you can get the best people involved in helping you build your business. And that can't be underestimated. This is not just somebody who writes a check, puts it in, you put it in the bank. This is a relationship that you're building.
Chris, any thoughts for the audience? Yes, go ahead.
Yeah, I was going to say that I think, and Howard and Ashley already, I think, stated this, but getting everybody on the same team within the company. Unfortunately, we're seeing a lot of situations, particularly in times when things are good, that you have part of the management suite linearly extrapolate the high watermark and want to use that as the guiding principle for how they're going to convey the story. And then the finance department or others who actually have to deliver, trying to keep pace. And when things are great and everything is going right, they sync up. But we all know that businesses go through cycles, and there will be challenging times. So getting everybody in the management suite, I've just seen too many examples where you have one group making promises that the other group doesn't feel comfortable delivering on, and that ultimately comes through. So, now's the time, as you're going out, and I do believe that now's the time to try to raise capital, or at least prepare for that. You have to make sure that everybody is on the same page, and ultimately focus on delivering an achievable plan, as opposed to all of the just promising upsides, because it will come back to bite you, whether it's a SPAC or an IPO or a venture round. Promising things that you can't deliver is as well.
Any thoughts, Blair?
I'm going to go with Charlie Munger and say I have nothing more to add.
Very good. There's haven't been able to get to all the questions. There's been several about it looks like about valuations. I think that maybe goes back to what Howard said at the outset, that these are frothy times. A question just came in. Let me ask this as we wind down. We're almost at the end here. Just so if someone has a brief answer, have you noticed a change in the investment horizon, meaning the time frame for exit? Has that changed? The time frame to liquidity to exit for VCs or private equity investors?
If I can just say one thing about that, the problem is a lot of people are looking at valuations that aren't really reflective of where institutional investors are participating. there's an awful lot of people who are taking their stimulus checks, sitting in their parents' basement and trading on Robinhood, that are deriving some of these valuations well beyond where the fundamentals of the company would support. So you have to sort of break that down into, when you look at valuation, the frothiness, a lot of it's coming from unsophisticated investors who are day trading and make a buck in the current environment, as opposed to the people that are actually doing fundamental analysis and understanding the prospects for that investment. And unfortunately, a lot of people get caught up the highest multiple they see trading in retail, as opposed to where the institutional investors are actually focused.
Unfortunately, I see that in the venture world too, though. I mean, we looked at an investment over in Asia last night for a company that's doing $1 million in revenue and might do 3 or 4 this year. And they were insistent on a minimum $100 million valuation. And, you know, a year ago or 2 years ago, they wouldn't have even had the nerve to say it. Now they're likely to get it, not from us, but they're likely to get it. So, you know, there's, and it is because of this. If I'm in the best company, it doesn't matter what I pay. It doesn't matter that Tesla's now trading above the market cap of all the other auto companies combined, and you're assuming that they're going to own the entire worldwide auto market in 2030 or 2026 or whatever, which is, I think all of us can agree, is unlikely to happen. But you have these other factors that are pushing people to lose their mind. You know, you just go back and read what's his name's book on the tulip mania. And you know, you realize what's going on, and it's going on again. It happens every decade or two, as a new group of people have to be schooled in what value really is. But we are creating real companies with real value, and I think it is true that instead of paying for 2 years out of earnings, we're willing to pay for 3 or 4 years out because rates are so low.
Yeah, fascinating. I wish I had time to ask more questions. Some others came in regards to like best practices, how to kind of get in front of VCs, how to get or investors in general, how to get their attention, what best, how best to work with them. I think there are a lot of areas that we left on the table for discussion. Having said that, this was really educational. I didn't expect so much discussion on stacks, but I should have anticipated that because it's such a hot topic. Blair, any final thoughts?
No, I just wanted to tell everybody who participated in the panel, both the panelists and the audience, you know, thanks so much for making the time. It's great to be able to do these Zoom panels. You know, you can roll out of bed and spend an hour and get some insights. I mean, I could ask you guys questions for several more hours, but I hope the audience got some value out of this, and really appreciate everybody making the time.
Thanks for having me.
So
Thank you.
Yeah, I'm sorry. Very good. Any final thoughts ending on a good note? What's exciting about the year ahead? Anyone want to take that on? What should we look forward to in 2020?
I was just going to say the same thing. Not 2020.
Vaccine, travel, you know.
My first shot, got my first shot 2 weeks ago, so the odds are good. I will be traveling again in 2 or 3 months.
The vaccine, that's one thing to be excited about. Okay. Yep. Anything else? Well, I would ask everyone to please join me in giving the panelists a virtual round of applause. I thought you guys were great. It was very educational, as I said, and I appreciate it. But I think we're over time now, so I appreciate it, and thank you very much. Not sure who to hand it off to. Blair.
Thank you. Yeah.
Thank you.
Okay.
This is the end.